Hi everyone, it's Jack back with another video. And today I'm going to be talking about a business that seems to be in the news every day at the minute, and that is Tesla. It's dropped 61% year to date that's pushed it down from around $1 trillion market cap to $490 billion. The CEO Elon Musk has lost his status as the world's richest man. It seems like this business is constantly in the news, very little for operating reasons, more so for Musk purchases of Twitter, for all sorts of things like that, for diverting employees away from Tesla, for no good reasons, whereas the operating business remains pretty much the same, has been performing pretty well. So I want to analyse this business, see how it's doing. It's right at its 52-week lows. Could this be a buying opportunity, or is it objectively high PE relative to other companies in this industry going to put enough people off? The most recent numbers we have for Tesla financially are the Q3 release in November, and the numbers, while not absolutely outrageously good, are pretty good. The stock dropped a little bit on the day because it's slightly, for expectations going forward, it wasn't ideal, but in terms of revenue, operating profit and free cash flow, it was a record quarter essentially. In the last 12 months, the free cash flow exceeded $8.9 billion, where if you asked me if they could do that a few years ago, I said absolutely not. And their operating margin was about 17.2%, which converts very favourably with them going forward. A big problem is the raw material cost inflation that's going to impact the profitability going forward and is harming the Berlin, Brandenburg and Gigafactory Texas big time. Operating cash flow of Q3 was $3.3 billion, very strong. $2.2 billion increase in cash, so now they have $21 billion in cash. Again, if you asked me a few years ago, this seemed completely unachievable. It's now a totally self-sustainable business. $3.7 billion in GAAP operating income, that's a 17.2% operating margin. 27.9% GAAP automotive gross margin, which can't get across to you how impressive that is compared to many other companies in this industry. 28% gross margin is absolutely fantastic for an automotive company. Record energy storage deployments. Overall, a really strong quarter operationally. Financials, just to put some numbers on it, total revenue grew 56% year over year to $21.5 billion, record revenue. Negative impact of foreign exchange was felt, as we've seen for pretty much every company around. Same on the profitability point of view, negative FX impact of $250 million. That's on $3.7 billion of profits, so a significant decrease. Higher raw material, commodity, logistics, warranty and expedite costs, and cost of production ramp at the two gigafactories really affected the profitability of this business, and that was probably why we saw a little bit of a decline in the stock price, but still not something to be worried about longer term. Digging into those numbers a bit deeper, automotive revenues up 55% year over year to $18.7 billion. So you're looking at around $3 billion of revenue from other sources. Gross profit up 42% year over year, really impressive. 27.9% gross margin, as I mentioned. That's down 258 basis points. Total revenues up 56%. Total gross profit up 47%. Still 152 basis point loss. Operating expenses grew modestly at just 2%, which is decent in my opinion. It's significantly lower quarter over quarter than it has been in Q4. It was around $2.2 billion. This quarter was just $1.7 billion. Income from operations, $3.7 billion, that's up 84%. Operating margin up 262 basis points from increased deliveries and so forth. Adjusted EBITDA up 55% with the margin only very slightly reduced. A lot to like here. Free cash flow up 148% year over year, and much, much stronger than it was earlier on in the year. In the previous quarter, it was just $662 million. This quarter, $3,297 million. Very, very impressive. 148% increase year over year, and cash is growing quickly, giving them certainly cash to spend on the other gigafactories expanding for worldwide, R&D and things like that, but also potential acquisitions going forward, maybe of smaller battery players. Digging a bit deeper into the operational side, just to emphasise how well this business is performing, because there's not really much to not like here. Model S and X production up 123% year over year, and Model 3 and Y production up 51% year over year. Very impressive. Deliveries up 101% and 40% respectively, for total deliveries up 42%. Total end of quarter vehicle lease count up 24%. Solar deployed, a little bit disappointing, only up 13% and lower quarter over quarter, but you can't have everything. Storage deployed up 62% year over year. Mobile service fleet 29%, and supercharger stations and connectors up 32 and 33%. From an operational point of view, they're really ramping up on pretty much everything. There's not a lot not to like here. The business is certainly operating well within its thesis, and it's just performing well. There's nothing really I can complain about. Tesla obviously commands a high valuation because it's growth. What's also really impressive for this business is the margins they can command. 27% gross margin is excellent for this industry. A 17% operating margin nearly is absolutely outstanding for this industry. And a net margin of 15% is nigh on unheard of in the automotive industry. Return on equity percentage 33 is again very, very strong. Return on assets, obviously automotive industry, it's a very asset heavy business, so to have a return on assets percentage of 17% is outstanding for this industry, and a return on invested capital of 27% is exactly what I'm looking for in any business. It's a very, very strong number. In terms of the balance sheet point of view, it is only getting better. A 3.6 cash to debt is absolutely fine. If you've asked me a couple of years ago, I would say that is absolutely unachievable for this business. Majority of it is long-term debt. If you look at the interest coverage of 55, that means with this year's EBIT, they could pay down the 55 years of the interest on the debt they have right now. That's why it has an Altman score around 12.1, meaning this company is safe from near-term financial distress, showing how far this company has come in just a few years. One thing that's often held against Tesla is its valuation. I don't think it's something it's ever really managed to get away from, and it's just an objectively expensive stock compared to the S&P 500. Now, it's a much better company than many of the companies on the S&P 500. It's by no means an average company, but a trailing P ratio of 50 is quite expensive. A forward P ratio of 31, I don't really think this is worth paying much attention to, because analyst estimates are really going to be quite far off 2023 in my opinion, because of a potential recession coming, and the analyst estimates are really not caught up with the potential recession that is coming in. It's a price of free cash flow of 65, which is quite expensive, way above the normal range I would be willing to pay. And of course, Tesla is growing its revenue at over 50% year over year, has good gross margins for the industry, although objectively not good for all industries. 27% is by no means outstanding. It's a fabulous company with long-term tailwinds, but some of these valuations are still quite high even after coming down 60%. Do I think it's worth paying for this company? Yeah, probably, because it's going to be growing its revenues consistently for a few more years in the 30 to 50 range at least. However, I can see why many people got out of this stock, because when it was a bit higher up, you're having a stock with a P ratio of 80 in a market that is plummeting, where highly valued stocks are being sold off because of inflation concerns and higher interest rates, then I can understand why many people have been in this company. I don't think it's an absolutely surefire bargain right now with a P ratio of 50, even when its revenue is going through the roof. There's a lot of rumours around Tesla at the minute, and one of the most interesting I saw though was Elon Musk is apparently looking at promoting Tesla China President Tom Zhu to global CEO. This would be a major win for me in my opinion. The stock may not like it in the short term, but for me, Elon Musk has been an unnecessary drag on this business in terms of volatility, and particularly the Twitter thing has just been a sideshow that Tesla has not needed. I think the stock has definitely suffered because of Elon Musk, one, stock selling to fund the Twitter purchase, and two, just from the unnecessary press that he brings to Tesla. And I think perhaps it is starting to look like the time where he passes the reins to someone else, still involved with the business, perhaps a chairman role. But for me, I just don't feel that comfortable investing in this business while his focus is clearly elsewhere. You can see very much from what is coming out of his mouth, everything that he talks about is Twitter recently. I just don't really want that in a CEO. I think Jack Dorsey proved that when he was CEO of Twitter and Square, Twitter certainly fell behind, because it is tough to be a CEO of two companies, particularly of that size, never mind CEO of 4 companies. That Elon Musk is 5 companies. You've got SpaceX, Twitter, Tesla, Neuralink, SolarCity, blah blah blah, whatever, the boring company. It's a lot on anyone's plate, and I think this is been a drag on the stock in what is otherwise a fantastic business that is absolutely investable. It's just, I'm really perturbed by this. Tesla is obviously a fantastic business that surely will be a major player in the growing EV market, which has tons of tailwinds behind it. Operationally, it's been performing absolutely fantastic. The financials only get better, and really, from a business point of view, there's not really much to fault it. It's performing admirably, even in the face of inflation and growing costs. It's performing really, really well, and having best in class really for the automotive industry gross margins. However, the valuation is probably on the high side still, even after a 60% decline, just because the market conditions right now, higher interest rates, it's hard to support a PE ratio of 50, even when your revenue is growing at 50%, because that gross margin really is not high enough to support that in my opinion. It's a fantastic business. This is certainly the cheapest it's been in a long time. Is it objectively cheap? I think probably not. It's definitely flirting with being a buy in my opinion. I just don't like the Elon Musk sideshow. I think there's definitely some stock price that could still fall. I think a P ratio of around 50, that's probably a little high for this market. If we go into a recession, this stock, the earnings for this company could certainly dry up and become very painful for shareholders with a steeper decline. I'm going to be staying out of this stock for the time being. Potentially a buy if it goes down much lower. If it goes close to 100, then I think I won't be able to resist. However, right now, it'd be a hold for me. Of course, I'm not a financial advisor. You should do your own research and due diligence. Let me know what you think in the comments below. I'll see you again next time.